Robert, thanks very much, and welcome everyone. To give you just a brief overview of my background, my name is Avi Goodman. I'm a managing director in the Transaction Advisory Services tax practice based out of New York City. Cover transactions mostly in the Northeast, but clients throughout the country as well. And generally, my focus is strictly on an M&A tax consulting perspective, focusing on tax due diligence, tax structuring, and tax modeling, representing buyers, representing sellers, and we do whether it's private equity or financial or strategic acquisitions, with sort of a broad range of types of transactions. I've been with BDO now for about 6 years, and prior to that, had a similar role at a Big Four firm as well. So I've been doing this for many years. I'm happy to have all of you here. Just a couple of things. One is I've got a lot of material here to cover today. I don't necessarily need to get to all the material, so as I'm going through things and we can keep this interactive, I think that would be helpful and make this enjoyable for everyone. If I talk about a transaction and you guys, someone has worked on a similar transaction and we want to delve into it a little bit better and talk about some of the tax issues, happy to do that as well. So feel free to interrupt me, ask questions, bring up any stories or anything, some transactions that you've worked on. My focus is typically on the tax aspects of transactions. There's many areas that I'm going to be speaking about that there's more than just tax ramifications that relate to. There's business issues, there's legal issues. I'll be covering those to a small extent, but my focus is going to primarily be on the tax issues. Just always keep in mind there are other items that will drive a transaction beyond tax. So, we talk about the pros and cons of different structures from a tax perspective. There might be other reasons that will lead someone one way or the other when choosing a transaction structure over the tax benefits. So with that, I'll get started. Let's see. I'll run through the agenda briefly. What I'm going to start with is really just an overview of different types of acquisition structures, basically talking about the pros and cons, primarily doing an equity, a stock transaction, or an asset transaction. Big picture perspective, there's really two ways to acquire a business. You do a stock deal, you do an asset deal, and then we can delve into each of those in a little bit more detail in terms of a stock deal and an asset deal, and then talk about various tax elections that are available that will sort of be a hybrid type treatment where you can have the legal form of your transaction goes one way, the tax treatment is as though you did the transaction a different way, and there are elections in place. Some of those elections are on one side where a buyer will make those elections. Some of those require joint election if it's going to impact both parties, and we'll talk about that. We're going to talk a little bit about the reorganization structure and a reference ruling from 2008 that we use a lot when we're dealing with S-corp transactions, and I'll get into a little bit more as to why that creates certain benefits or eliminates certain risks and bring on its own issues. Talk about earn-outs briefly, just in terms of transactions, that impacts both buyer and seller in terms of future payments, and talk about some of the issues there. And the last thing I want to talk about a little bit is just give an overview of the tax due diligence process and things to be thinking about when you're doing an acquisition, or if you're potentially going to be acquired, just being on the other side of the tax due diligence as well. With that, I'll get started. The main thing I want to start with is the different types of transactions. And you can have a stock deal or an asset deal. Those are basically the two types of transactions. I always like to think of a company as a box. And so picture if you're buying the stock, you're buying the entire box, which means you get everything inside and you get the box itself. The box can include all of the assets of the corporation, includes all the liabilities on the balance sheet. There could also be a lot of unknowns. There could be tax risks in there. For example, if they take into bad positions on prior returns and you're buying that box, you're now inheriting all of those bad positions. Again, I'm focusing on the tax issues, but there could be other issues. There could be environmental risks, product recalls, things like that, depending on the nature of the business. When you buy the box, you're buying all of that. Sometimes when you buy assets, some of those risks you're able to leave behind. Sometimes certain risks follow the assets. And I'll talk about the ones that do that from a tax perspective. But obviously there's other legal issues as well. what are some of the concerns that you generally would be thinking about when you're doing an asset deal? The main reason as a buyer you want to do an asset deal is to get future tax deductions. If you buy assets, what generally would happen is you allocate your purchase price to the various assets of the business, and then over time those will create some tax deductions for you. So for example, if you allocate cost to inventory, it's going to increase your cost of goods sold in future years, or probably even in the next period, depending on the inventory term. If you allocate to fixed assets, right now with bonus depreciation, if those assets would qualify for bonus depreciation, you get an immediate tax write-off. If it's not eligible for bonus, you'll get a tax write-off over a number of years. If you're allocating it to intangibles, for tax purposes, intangible amortization works a little bit different than book. Generally speaking, for tax, all intangible assets, whether it's goodwill, going concern value, or identifiable intangibles, generally 15-year amortization. So basically, as soon as when you do an asset deal, that's usually what people focus on in terms of is the amortization deduction that over the 15-year period. Depending on how you allocate purchase price, you might be able to accelerate some of those benefits. If you're doing a stock deal, we talk about tax attributes. Attributes can really be a tax deal or an asset deal. If you're buying stock of a company, most people think of an attribute that would come across as like a net operating loss. The other things that would be, if you're buying stock of a company, high asset basis is also a tax attribute, which is why I'm saying if you're buying the assets of a company, even though you wouldn't get things like net operating losses, you would get higher asset basis, and that creates deductions over time. So I would think of that as an attribute as well. If you're buying the stock of a company, even though the attributes come along, you always have to be cognizant of limitations on use. So for example, if you're buying a company that has a net operating loss that you can use to offset your taxable income in a future period, the fact that there's a change in control could create limitations, which is beyond what we're going to cover today. But just keep in mind, just because you're getting certain tax attributes, you also have to do an analysis to see what the use and benefit would be for you on a go-forward basis. Tax liabilities, generally with that, I really think of it as if you're buying in terms of more on the contingency side, when you're doing a stock deal, you're getting all liabilities, known and unknown. If you're doing an asset deal, for the most part, you can sort of cherry pick which liabilities come across. Working capital will be common to leave behind certain things, but there are some contingencies or risk type liabilities that follow the assets, and we'll talk about that a little bit. I think one of the key benefits of an asset deal too is you can sort of select what assets and liabilities come over and be specific about that. It's very difficult if you're buying the stock of a company to kind of cherry pick your assets and tell them, oh, you have to spin this off, you have to get everything set up. But if you're doing an asset deal, you can literally negotiate with the buyer between a buyer and seller and say, these are the specific assets and liabilities I'm buying, here's what I'm paying, and we'll transfer those over. I think we've already talked about some of these examples of tax attributes when you're a buyer. High stock basis, if you're buying a stock, you don't amortize the basis of a stock. That's one of the key disadvantages from a buyer's perspective of doing a stock deal is you get your basis in the stock and it'll sit there. So at some point in the future, if you're going to exit and sell that stock, you will at that point have a higher basis, which would ultimately reduce your gain. So if you sell it for a premium of what you paid, the stock of the business, you only, from a tax perspective, you're only going to be taxed on the gain, not on your total proceeds. So I look at that as an attribute. Not typically when people think of as attributes. Usually it's if you're doing an asset deal, you're getting the basis and the assets themselves. Certain variables. Escrows and earnouts, that really gets more to sort of deferred payments. An escrow, I'm sure most of you are familiar with, if you're doing a transaction, what would happen is typically the buyer, rather than the seller getting 100% of the proceeds, the buyer would expect a certain amount of the proceeds to be held back in escrow, so that if they are future claims that the buyer has against the seller for any indemnities or certain risks that may come up, the buyer has the escrow to go after. And then an earnout is most of you are probably familiar with this, but when you're buying a company, if there is a discrepancy, usually you would pay like a multiple of earnings or a multiple of EBITDA for a business. That's a common pricing mechanism. What happens is a buyer and seller don't always agree as to what a good EBITDA run rate is for the business to pay the multiple based on that. They might agree we're going to sell this business for 7 times, 8 times, 9 times, whatever the multiple is, but what number last 12 months, you kind of have to come up to a normalized EBITDA type, and then financial due diligence is typically what you would, the services that you would use to help you do that. But once you come up with that, if buyer and seller still don't agree as to what a normal rate is, so let's say, for example, a seller says, we're going to be earning $100 million of EBITDA, and a buyer does their analysis and they think the real number is $85 million. That the buyer might say, well, we'll pay you now based on the 85, but if in the next 3 years you do meet targets that get you up to get up to the 100 and that number is real, we'll pay you at that point based on that. So it's basically a way to kind of bridge that gap a little bit. And there are tax implications too from both the buyer and seller as to earnouts and deferrals. Some of the game items that a seller is specifically thinking about. Seller, really from a tax perspective, there's always two items that you want to be thinking about. What is the timing of when I have to pay the tax, and what is the character of the gain? And obviously there's a tax amount itself, and then there's the timing and the character. From a character perspective, it's basically capital versus ordinary income. So if you have, as an individual, a seller, or if it's an S corp where the company is doing a deal but it flows up to you as an individual, or something similar in a partnership, the nature of the income is very important to you, because right now, most states, there's really no difference. Ordinary capital and rate should be the same from a state tax perspective. From a federal perspective, the highest ordinary rate right now is 37%. Most of the time, the year you're selling a business, you're going to use the highest marginal rates that really focus on, and the highest capital gain rate is 20%. So you would end up with a rate differential of 17%, and that's a significant number. So as a seller, you're focused on the character of income, and also double taxation has to do with if you're a corporation. If you're a corporation, and other than an S corp, which is a flow through, if you're a C corp sells assets and then distributes up the proceeds, usually is a bad answer, because there would end up being a double tax on that. So the shareholder would be better off selling stock in that case. Because if the company sells assets, the corporation pays tax, distributes up after-tax proceeds up to the owner, who then pays a second layer of tax on them. Other issues that sellers would be thinking about would be the basis of consideration received. If you're getting something other than cash, what is your basis? And most of the time the seller's getting cash or equity, and it's either it's equity, it's going to be carryover basis or fair market value, depending on how you structured it. But if you're getting anything else, you want to understand what's your basis in it, and get other assets as consideration. The installment sale rules, that has to do with, as a seller, we talked about earnouts and escrows, and I think those are really related. Under the installment sale rules, if your earnout and escrow meet certain criteria, there are rules in place that allow you to defer the gain recognition and the taxability until you actually receive the proceeds. So if you're not going to be getting some of the proceeds for a few years after closing, there might be a strategy to defer some of the gain, depending on the nature of how those arrangements are set up. With escrows, you have to be a little bit careful. If a seller says, "Oh, I want to defer some of the gain, so let's put it in this bank account, but I'm free to go and take it whenever I want," that's not going to work. It's really got to be more to the buyer's benefit, and there are specific criteria to be looking at there. Earnouts generally qualify for installment sale treatment. We get into some weird rules depending on whether the earnout is capped, whether there is a defined time frame, things like that. And again, beyond what I'm going to cover here, we'll just keep in mind as a seller, they're going to be concerned about the timing of the gain recognition in addition to the character. This, I think, is a very important slide. I think it kind of sums up what I've been saying. I want to spell this out a little bit more. As a buyer, I think we've established that it's generally better to buy assets, because you get, from a tax perspective, a buyer will almost always want to buy assets because they get a fair market value basis in those assets that allows them to get the tax write-off over time, whatever those assets are. Again, it could be, if it's an inventory, if it's a fixed asset, you're going to get some sort of accelerated depreciation schedule. Inventory will end up with cost of goods sold hopefully in the near term, and intangibles, they will be able to write off over 15 years. So, and whereas opposed to if they buy stock, there'll be a carryover basis, there'll be no write-up for tax purposes of the assets, no future tax shield on the earnings, and the basis just kind of sits in the stock until they ultimately exit. The other thing here is the purchase price allocation. A buyer, in addition to wanting to buy assets, a buyer is going to always want to push to allocate the proceeds to the short-lived assets. Inventory is a great one that usually turns over fairly quickly. Again, we talked about bonus depreciation. That's another one that usually can write off the first year. Used assets under tax reform now qualify. You have to look into what type of assets they are, but it's not as, since the tax reform at the end of 2017, you were actually able to do asset deals where someone is buying used property from another business and then is able to get bonus depreciation. Again, some assets don't qualify.
What's the biggest difference, I guess, with tax reform that we're seeing? Is the buy side or the sell side, the way that they're setting up the transactions, or is it?
I mean, I think, fixed assets is one of them. I think there's probably more of a push. It used to be, for example, some assets that would have been, let's say, 5-year, 7-year, so, different lived assets that now are eligible for bonus depreciation. It used to be someone was deciding between, let's say, 5-year, 7-year, or 15-year, if they just didn't allocate a lot to the fixed assets and allocated more to, let's say, an intangible. Now the cost recovery happening in year one is a huge reason that buyers will be pushing for more purchase price allocation. I think that's probably one thing. I think there's really, I think a few issues, things in terms of, tax reform. Some of the things, for example, the tax rates went down a little bit, went from 39.6 down to 37. So I don't think there's that much of a shift in terms of people's concern about ordinary income. I think it's still a big delta from capital gains. But I think with respect to these items, that's probably what I'm saying. I think the bigger side of tax reform, and we haven't really spoken about this yet, is the corporate tax rate has gone down from 35 to 21%. So when a buyer is figuring out what their future tax shield is, the math changes a lot, because what happens is from that perspective, what used to be, if they put a 15-year asset, let's say intangibles or something else, and they're going to write it off over 15 years, they're offsetting income that they'd otherwise be paying tax on at 35%. Now their overall tax rate went down to 21% federally. So even though, yes, you're saving more money on tax, if you look at the step up in isolation, there's arguably less value, because it's only offsetting at a 21% rate. So I think that's, but we're still seeing, there's still, buyers still want to get the step up, they still appreciate having the tax shield, probably a little bit less value on it. And the last thing I'll mention, to answer the question, is what I'm also seeing is buyers, even though we're sort of valuing the step up, because what we didn't really cover yet is there's a lot of times it's beneficial to a buyer, but it costs a seller more money to do a transaction as an asset deal, and we'll talk about that a little bit. But a lot of times the value to the buyer will far outweigh the cost to the seller, so it's easy for a buyer to say, and as an example, we've done a deal recently where the cost of the buyer was maybe $500,000, the cost of the seller was about $500,000, the value to the buyer was about $20 million. It was very easy for the buyer to just say, I'll pay the extra $500,000 and gross it up, and it's the $500,000 becomes taxable, so it might have to be $800,000 or however the math works, but it's sometimes the math is that simple that it's too easy to do it.
I actually did a deal like that. It was going to be a stock deal, and the price was a little too rich for us. We went back and we were able to convert the stock deal into an asset deal, and because the seller had some carried forward losses or in a different tax position, we were able to agree to doing an asset deal.
That's great. And this was a C Corp target?
It was a C Corp, and we bought the company. It was owned by a PE firm.
Okay.
And I guess they had losses, they had experienced losses, so they were able to get to the same spot with a renegotiated, price and conversion from a stock to an asset deal. So it helped us as the buyers, and the seller did all right too.
That's great. I mean, that's a great example, because so from their perspective, if you bought the stock and they had net operating losses, those would not be worth nearly as much to you as they are to them, because from your perspective, they would be limited under other tax rules that we're not going to get into here, but you can't just buy a company with a net operating loss and just use them the next year. I mean, there's a lot of rules that come into play in terms of how the limitation would work. So, but if they do it on if on the seller's watch, they sell you the assets, they meaning the corporation sells you the assets, assuming they haven't had a previous ownership change or anything weird like that, they would be able to basically have the gain on the asset sale, use their NOL to offset it, and then, distribute up the proceeds, and, and essentially the NOL can, if math works the way it should, can serve to mitigate or even perfectly eliminate a second layer of tax. Again, it depends on the numbers, but I think that's a great example. And then from your perspective, the deal makes a little more sense because you're now getting the tax shield every year. So from an NPV perspective, these assets are worth that much more to you. So that's a great example.
You didn't buy the whole box.
What's that? Yeah, well, that's right. And and the other thing too, which we don't focus on when we're talking about the tax benefits, but we have to think about this more when we're doing due diligence on targets. So I think that's a good example too. Is sometimes there are other transaction structures which we're going to touch on a little bit, where a buyer can still, where you'd be able to buy the stock, and if the company has losses, you can make an election that they treated it as though they sold you the assets. You would only do something like that if they have losses that you can basically, you're going to trigger a huge tax gain, so it's not something that's used that commonly. In the case of a company with a net operating loss, it is a strategy you can potentially use. It's when we talk about the 338G election. I have a couple slides on that later on. But the risk there is, let's say those NOLs aren't really good, then you've all of a sudden, it happened on your watch, you triggered the gain, used those losses, and now if the IRS ever comes in and says, prove these are good losses, and you need to sort of demonstrate that, and you can't, you've triggered a tax and you don't have NOLs. The way you structured your deal was very smart, because now if there's an issue with those NOLs, it's on their watch, and they're not going to be able to come back to you and say, oh, the IRS disallowed our NOLs. You'll say that's your problem. So I think that's a great example. Focusing on the sell side, the seller will generally wish to sell stock instead of assets, and that kind of gets to the character of the gain. If the seller is selling stock, they're going to pay capital gains rates as an individual, which is 20% as opposed to 37%. If you're selling assets, if it's an S corp or a flow-through type business that's selling assets, what would happen is the extent you're allocating purchase price to ordinary income assets, and that can include fixed assets to the extent of depreciation taken, which comes out as depreciation recapture, then you end up with a situation where the seller is paying 37% instead of 20% on those assets. If the other one has to do with if it's a corporation and it's a C corp and you don't have net operating losses as you did in your situation, then what would happen there is you end up in the situation where there's a double taxation. The C corp sells assets and distributes the proceeds. You almost never see that happen, an asset deal in a C corp, unless there's a net operating loss. It would, I'm not going to say never, but almost never make sense, because of this, the second layer of tax would be too prohibitive from the seller's perspective. But if it is an asset deal, the seller is going to be looking to allocate purchase price to capital assets, just to eliminate some of that rate differential issue. One thing that's not on this slide is also something to think about. Comes up more when you're dealing with flow-throughs. I think in the S corp context I see a lot is state and local taxes. For state and local taxes, if a seller sells stock, they only pay tax in their home state. So they have their federal taxes, and if they live in, let's say, New York, where individual rates are close to 9%, they're going to pay the 9% here in New York. If the seller's in Florida, which has no income tax, they're going to pay zero state, and they'll just pay their federal. But if you have a business, let's say you have, and we see this sometimes, a Florida shareholder, but the business has all its operations as an extreme here in New York with a Florida shareholder. That Florida shareholder, if they do an asset deal, the business is picking up that gain and it has to pay tax in New York. And New York would have sort of a non-resident withholding type mechanism to tax the Florida shareholder. So that would be that answer. If you're dealing with, let's say, New York, New Jersey, most of it is mitigated because it corrects itself through, like, as an individual, if you pay taxes to another state, it'll correct itself through, like, a credit mechanism. It's not necessarily perfectly dollar for dollar, but it mitigates a larger piece of it. When you deal with, if you have a company that has Florida shareholders, Nevada, there's a handful of states that have zero income tax or really low rates, state and local tax can become a big consideration as well. There's a few non-tax issues. I'm not going to spend too much time on these, but I thought it was important to kind of put them in here. We talk about asset deals and stock deals as though you can easily pick between the two. It's not always easy to do an asset deal. You have to retitle assets. You might need consents depending on what those assets are. You have to reassign contracts, reassign rental agreement. There's a lot involved that the corporate attorneys will be working with you on. But most attorneys will tell you asset deals are very difficult for them to do, which is why we have several strategies that we use from a tax perspective, where you basically do a legal stock deal. And sometimes you do an actual stock deal, and we talk about the 338 and 336E election that I'll talk about a little bit later. Sometimes it's something as simple as, if they're able to do it, is maybe they could drop the assets into a single member LLC. Sometimes that still requires retitling, but sometimes that's a little bit easier, because from a tax perspective, if you buy 100% of a single member LLC, you're treated as having bought the assets and they're treated as having sold it. So sometimes that works, sometimes it creates the same issues in terms of transferring assets. Need only assume certain liabilities. Again, you can kind of cherry pick. You can say, I'm going to only take your working capital liabilities, I'm not going to take on some of the others. For legal purposes, there are some liabilities that attach to assets. From a tax perspective, examples of liabilities that attach to assets are sales tax exposures. So if you have a sales tax issue in your business, and let's say you weren't collecting sales tax in some of the states that you're operating in, and then you sell the assets of the business, the buyer of those assets will still be on the hook for your historic sales tax liability. Income tax liability generally stays behind, but sales tax does not. Employment tax, if you were paying all your employees as 1099s and not on W-2s, and you come in and you get audited for that after an asset deal where part of the assets is basically what the employees moved over, same thing, you would be on the hook for that historic exposure. Those are a couple of examples. I think unclaimed property is state by state, it's not really a tax, but we sometimes think of it as one. So you don't necessarily leave everything behind, but there are some assets that some liabilities that will follow assets.
Is that the same with a stock transaction? You're liable for those same liabilities?
Yeah, it would be the same for the ones that I mentioned, but in a stock transaction there would be many more. The key one being income tax liability. Income tax liability is generally left behind in an asset deal because the entity is who's responsible for it. But that's a good question. I mean, we deal with this in the S corp context a lot, where an S corp, from an income tax perspective, doesn't pay any taxes. So if you do an S corp stock deal, even though it's not a taxable entity, what happens if 6 months later the IRS audits, 2 years ago, the S corp, and it says you guys violated your S corp status and you're no longer a good S corp? Let's say they have 2 shareholders and they're giving one of them a preferred return because no one told them they weren't allowed to do that. And from an S corp perspective, they're required to have a single class of stock, so you can have someone getting a preferred return. If that's the case and they lose their S status, that means that for the historic period they should have been filing taxes and paying as a C corp. You've now inherited that risk, and you would owe their taxes for the historic periods at 21%. Arguably, the seller in that case would amend their returns because they paid some at the individual level, but it doesn't work perfectly. It gets very complicated. Why would we ever do an asset? I think we've really spoken about most of these. You basically buy the discrete assets is a good one. The other one here is a good example that you mentioned earlier, is that there's net operating losses to offset the gain, or another time is maybe a seller, maybe the company that's selling you assets actually has a very high basis in those assets compared to the selling price. In that case, their taxable gain may not be so much. If they're recently acquired assets and they're selling it to you for close to what they paid, they may not even care, because if there's not a lot of gain, then when they distribute out the money, they can get to a single level of tax. So there are times, I'm not going to get into these other issues, but there are times that you can, some of these issues just based on the facts, the specific facts, are less of an issue. In a stock deal, some of this seems obvious. You recognize gain based on you get proceeds for each share of stock. You have basis in it based on what you paid for the stock. The difference is your gain. The acquirer gets a cost basis in the share. It sits there. There's no tax shield. There's no amortization or depreciation on your basis in the stock. And then the key thing here is T, the target, survives the stock sale intact. That means when you buy the box, everything in the box just moves over. So if there's low asset basis inside, you get that. You're not getting the step up for depreciation. There's tax attributes, net operating losses, business credits, AMT credits, what have you, capital loss carry forwards. Those all come over as well. Just keep in mind there could be limitations on their use. Actually, one that we see now, which it's not really in the slides, but we were talking about tax reform before, is interest limitations. Now there's the new rules limiting interest deductions for companies to essentially it's 30% of EBITDA. Right now it's going to change in a couple of years, but if you don't get to use that deduction in the current year, you get to carry forward your unused deduction, that basically becomes an attribute that would move over. Again, that would also be subject to limitations similar to net operating losses.